Welcome back to Smart Stock Sam, the channel where we cut through the noise, follow the data, and find the trades that actually matter. If you are new here, every single week we take stocks that have something genuinely interesting happening underneath the surface, and we break them down the way a professional trader would, not with hype, not with pump energy, but with actual data, actual charts, and actual discipline. And today we are talking about Datavault AI, ticker symbol DVLT. This company is sitting at a genuinely fascinating crossroads right now. A confirmed multi-million-dollar commercial deal just got signed, institutional money is pouring in on one side while running for the hills on the other, and short sellers are piling on so aggressively that they might just be setting themselves up for the pain trade of the year. Is a massive breakout imminent on DVLT? Could this 50-cent stock actually deliver a move that changes the game for traders who get positioned early? Stick with me through this entire video because there is one hidden metric buried inside this setup, and when we get to it, it is going to completely reframe how you see this trade. This is DVLT. Let us get into it. So first, what does Datavault AI actually do? Because if you cannot explain what a company does in under 30 seconds, you probably should not be trading it. Here is the simple version. Datavault has planted its flag directly at the intersection of two of the most explosive sectors in modern finance. On one side, you have AI-driven edge computing, the physical backbone, the actual hardware infrastructure that makes artificial intelligence possible in the real world. On the other side, you have blockchain real-world asset tokenization. Now, if that phrase sounds complicated, think of it this way. Imagine you own a gold mine, a geothermal energy plant, or a copper reserve. Traditionally, those assets are locked up, illiquid, and inaccessible to the average investor. What Datavault is doing is converting those physical, real-world assets into digital tokens that anyone on the planet can buy, sell, and trade around the clock. And here is why that matters at a macro level. Experts are projecting this real-world asset tokenization sector alone could represent a multi-trillion-dollar total addressable market by the year 2030. That is not a rounding error. That is a generational market opportunity. Now, retail sentiment online has started calling DVLT a bumpy road. And honestly, they are not wrong. But bumpy roads sometimes lead to the most spectacular destinations, and the underlying macro tailwind here is about as powerful as it gets. The question is whether management can actually execute against that opportunity, and that is exactly what we are about to find out. Let us talk about the $38 million elephant in the room, because narratives are great, but hard contracts are what move stock prices. Recently, Datavault signed a mutual services agreement with Perpetuals.com, an EU-licensed crypto exchange. And this agreement is a genuine game changer for one very specific reason. It does not just position Datavault as a company that issues tokens. It positions them as a company that generates ongoing revenue from active, 24/7 global market trading. Think about that distinction carefully. The difference between issuing a token and generating fees from trading that token is like the difference between selling a house once and collecting rent on it every single month forever. They are rolling out a series of specific vaults under this agreement. Gold Vault is targeting over $150 million. Coppercoin is targeting $100 million. Triton Geothermal comes in at $120 million. And American Strategic Minerals rounds it out at $78.2 million. When you add all of that together, you are looking at a confirmed initial issuance of over $328 million. But here is the number that should be jumping out at you. This structure is estimated to generate $38 million in direct fee revenue for Datavault. On a company trading at 50 cents a share, that is not a small number. That is a transformational number, and management did not stop there. In parallel to the crypto asset strategy, Datavault is absorbing a cybersecurity firm called CyberCatch. The acquisition costs them approximately 49.9 million newly issued shares, giving CyberCatch a 7.52% stake in the combined company. Now, why would a tokenization company want a cybersecurity firm? Because they are not just building the vault, they are building the guns to protect it. The strategic output of this acquisition is what the company is calling a quantum-resistant security layer. Here is some important context. The cybersecurity industry is currently watching the calendar very closely for what experts are calling Q-Day, the point in the near future when quantum computers become powerful enough to break the traditional encryption that protects virtually all global digital infrastructure. Banks, governments, exchanges, hospitals, essentially everything that uses a password or a private key becomes potentially vulnerable. Datavault is positioning itself to sell enterprise-level quantum-resistant defense contracts before that day arrives, and the physical infrastructure they are building to do it is genuinely impressive. 1,000 edge microsites, housing 48,000 active GPUs. Could this company actually become the cybersecurity backbone of the post-quantum internet? It sounds far-fetched today, but the biggest winners in tech history always sounded far-fetched at 50 cents a share. Now here is where the story gets genuinely complicated. If the fundamentals are this compelling, why is the institutional picture so confusing? Right now, total institutional ownership sits at approximately 46.39 million shares. That represents only about 5.42% of outstanding shares, a total value of around $28.87 million spread across 101 different institutional owners. But here is the wild part. The sentiment flow between those institutions is violently split right down the middle. On the accumulation side, you have heavy hitters like Morgan Stanley and BlackRock actively adding to their positions. These are not small players making careless bets. These are among the most sophisticated capital allocators on the planet, and they are buying DVLT. But on the other side of that equation, State Street Corporation recently reduced their holdings by a staggering 84.79%. 84.79%. That is not trimming a position. That is a near-complete exit. So what do you do when BlackRock is buying what State Street is selling? You hold both possibilities in your head at the same time, and you let the price action be your referee. Because when the smartest money in the world is split this cleanly, the trade becomes about timing, not conviction. Let us build the ultimate bull versus bear reality check, because this is the part of the video where a lot of YouTube channels go soft. They pick a side and ignore the other. We are not doing that here. The bull case is genuinely seductive. Datavault is perfectly positioned at the AI and real-world asset intersection. They have a tangible, confirmed commercial victory with the perpetuals deal expected to bring in $38 million in fees. And they are aggressively building strategic physical infrastructure with 48,000 GPUs. That is real. That is not a press release promise. But here is the bare reality. And this is that hidden metric I mentioned at the top of the video. The cash burn numbers are brutal. In the first quarter of 2025, Datavault reported a net loss of $9.563 million. Fast forward exactly 1 year to the first quarter of 2026, and that net loss has exploded to negative $53.131 million. Think about that trajectory for a moment. The cash burn did not double. It did not triple. It nearly quintupled in a single year. It is like trying to fill a swimming pool with a garden hose while someone opened a drain the size of a manhole cover at the bottom. This is the fundamental friction point, preventing any long-term investment stability in this stock. You simply cannot build 1,000 physical server sites for free. And this massive cash burn has one deeply uncomfortable implication. At some point, management will almost certainly need to issue new shares to raise capital, and every new share they print is one more dilution hit to the value of the shares you hold today. That is the bare reality. Do not look away from it. Now, because of that financial bleed rate, Wall Street has painted a giant target on Datavault's back. Right now, there are nearly 89 million shares sold short. That represents 14.91% of the entire tradable float. To put that in perspective, it would take short sellers 2.53 days of non-stop buying at average daily volume just to close out their positions. But here is where it gets spicy. short sellers are currently paying a borrow fee rate of 12.41% annually just for the privilege of betting against this company. Every single day they hold that short position, it is costing them money. And if we look at off-exchange dark pool flow, short volume has been dominating, averaging between 51.56% and 70.81% of daily volume. This is aggressive, institutional-level bearish conviction. They smell blood in the water because of that $53 million cash burn. But here is the question worth sitting with. What happens to all those shorts if a major catalyst lands and the price starts moving the wrong way for them? From a macro-technical standpoint, the bears have full control of the chart. The stock is sitting at 50 cents, buried underneath all of its major exponential moving averages. The 20-day EMA is acting as an immediate overhead ceiling at 53 cents. The 50-day EMA is a midterm ceiling at 62 cents. And the 200-day EMA is way up at 86 cents. Every single one of these moving averages is above the current price, stacked like a ceiling of resistance. That confirms a primary bearish structure, and it totally validates why short sellers have so much confidence in this setup. But, and this is a critical but, macro bearish structures do not stay bearish forever. They reload, and when the compression finally breaks, it breaks hard. So what is this stock actually worth to a disciplined trader right now? Let me be direct with you, because that is what Smart Stock Sam is about. My honest long-term investment outlook on DVLT is bearish. You simply cannot build durable long-term conviction until that $53.1 million cash burn shows a meaningful reversal. That is just financial discipline. However, my short-term trading outlook is volatile and surprisingly bullish. Here is why. We have massive real-world asset catalysts. We have a heavily loaded 14.91% short float. We have institutional names like BlackRock accumulating. And the stock is sitting right on a psychological support level of 50 cents. The setup is not a buy and hold story. It is a tactical compression trade. This is what I'm calling the squeeze engine, the exact mechanical process by which we profit from this setup. Step 1. The price breaches the 20-day EMA at 53 cents. The moment that happens, algorithmic systems programmed to detect breakouts immediately trigger automated buy orders, and breakout traders who have been watching this level jump in simultaneously. That creates an instant burst of buying pressure. Step 2. Those fresh buy orders push the price higher and the chart starts turning green. Step 3. Short sellers, who are already bleeding that 12.41% borrow fee every day they hold their position, suddenly face accelerating unrealized losses. At a certain pain threshold, they are forced to buy shares to close out and stop the bleeding before it gets worse. They have no choice. Step 4. That forced buying creates a wave of synthetic buy pressure that did not exist anywhere in the natural order flow. It becomes a self-reinforcing mechanical loop. Every new buyer forces more short sellers to cover, which forces more buyers in, which forces more covering. The whole thing can accelerate like an avalanche. And when that loop gets going, the target price moves towards 62 cents, the 50-day EMA, with shocking speed. Could this squeeze actually run all the way back to the 200-day EMA at 86 cents? On a first move, that is extremely unlikely. But a quick 20 to 25% pop from 50 cents on the right catalyst with this short float loaded up the way it is, that is absolutely within the realm of possibility. Zoom into the intraday time frame, and the picture gets even more interesting. While the macro chart looks terrible, the microchart is holding strong. The current price of 50 cents is sitting above the 20-hour EMA at 49 cents and the 50-hour EMA at 48 cents. The RSI is neutral, sitting between 43 and 51, meaning the stock has room to run in either direction without being technically overbought. The MACD is flat near zero. This is classic market indecision. The bulls and bears are locked in a stalemate, coiling tighter and tighter, waiting for one catalyst to tip the balance. Before we map out the exact entries and targets, we have to talk risk, because this stock will test your discipline. The average true range is 5 cents. On a 50-cent stock, that is a 10% average daily swing. You must size your position to accommodate that noise level without being shaken out prematurely. And there is one hard line in the sand. If the stock loses support at 46 cents, the entire bullish setup is invalidated. Below 46 cents, there is a technical trapdoor that opens directly down toward 37 cents. That is not a slow grind lower, that is a cliff. Do not ignore it. Here is your complete tactical trade map. At the bottom, the trapdoor stop zone sits between 45 and 46 cents. In the middle, the pivot and bounce zone sits between 48 and 50 cents. The breakout trigger is at 53 cents. Above that, conservative target 1 is at 55 cents, the recent swing high. And aggressive short squeeze target 2 is the 50-day EMA at 62 cents. Here is your exact execution protocol for the first week of June. Scenario A is the breakout entry. You enter at 54 cents, but only on a confirmed daily close or a high-volume push above 53 cents. That confirmation tells you the shorts are genuinely trapped. Scenario B is the bounce entry. If the broader market pulls back intraday, you can enter between 48 and 49 cents, assuming the micro EMAs hold. Target exits are 55 cents for conservative traders, 62 cents if you are playing for the full squeeze. Your hard stop loss is 45 cents, non-negotiable, and if the price crosses 53 cents after your entry, you immediately move your trailing stop to your break-even price. That locks in your downside protection and lets you ride any momentum completely risk-free. Now, before we wrap up, there is something important I need to say, and I mean this sincerely. Everything discussed in this video is for educational and informational purposes only. Nothing here constitutes financial advice, investment advice, or a recommendation to buy or sell any security. I am not a licensed financial advisor. DVLT is an extremely speculative microcap stock with real documented cash burn and significant dilution risk. You could lose every single dollar you invest. Always do your own research. Always consult a qualified financial professional before making investment decisions. Never invest money you cannot afford to lose completely. The stock market involves substantial risk, and speculative microcap stocks carry risk that is exponentially higher than the broader market. Trade smart. Protect your capital first. And with that said, here is where I land on DVLT. The long-term story is too risky to hold blindly. The cash burn is real, the dilution is coming, and the bears are not wrong about the fundamentals. But the short-term setup is genuinely one of the more interesting compression trades I have seen in this sector this year. $38 million in confirmed fee potential, a quantum security build-out, BlackRock accumulating, and nearly 15% of the float sold short, all stacked on a 50-cent psychological support level. The spring is coiled. The question is, what pulls the trigger? So here is what I want to know from you. Drop this in the comments right now. If DVLT gets the regulatory green light in Europe for the perpetuals tokenization rollout this summer, do you think this stock sees $1 before it sees 25 cents? Make your case below. I read every single comment and I will be responding all week. If this breakdown gave you value, hit the like button. It genuinely helps this channel reach more serious traders. If you are not subscribed yet, hit subscribe right now because we do this exact style of data-driven analysis every single week. And if you want to directly support Smart Stock Sam, YouTube has a super thanks feature right below this video. Any amount keeps this channel growing and independent. I am Smart Stock Sam. Stick to the data, manage your risk, and I will see you in the next one.